Hi and welcome back to the channel The Kaizen Trader. My name's Tom and you'll probably know me better as The Kaizen Trader from Instagram, Twitter, ASFX. In today's video I'm going to go over a trade review and a trade that I've taken earlier this week on the GBPUSD pair. And it's very similar to a trade that I took a couple of weeks ago. So we'll be looking back over both of the trades and looking at similarities between the two, and if there was anything that I could have done to maybe lower my risk or even not take the trade in the first instance. So yes, we're going to go over a trade review on GBPUSD. And if you do find value in this video, please hit subscribe, please comment below and like. So in the trade review we'll also go through my sort of thought process, why this pair was on my watch list, what I liked about the trade before I took it, the process in leading up to taking the trade, and then the process after the trade, and then we'll do a bit of a trade review, what I did well, what I did badly, or what I could have done better, and then what that means taking lessons into the future and how we're going to implement them moving forward. So this is the first trade that we're going to review, and this was the trade that I took this week on GBPUSD as an A1, and we were looking to buy this as a breakout off the 21 and through the 80 MA using the ASFX A1 entry. Back at the start of the day, as I arrived at the desk at 7 o'clock and created my watch list, and the GBPUSD made my watch list because of this perfect market sentiment line. So that's this yellow line on the TDI, and we can see that that's firmly in the buy zone all day and overnight from the start of the Asian session. So what I'm looking for on this market sentiment line is that it's got a value above 50. Anything above 50, it means that the market sentiment is looking for buys. By having this market sentiment line in the buy zone and above 50, from the back testing, it means that there are increased probabilities that buys are going to work. So that's the first thing, and what we want is that to have been in this zone since the start of the Asian session at 10 o'clock last night, all the way through to when we take the trade. And as you can see here at just 10:30 when we take this trade, that yellow line is firmly in the buy zone and just nice and flat, really steady, indicating that we want to go long. The second thing that I'm looking for in the morning is the potential for EMAs to be in full trend at the time of entry. So you can see here that these EMAs are in full trend, and what that means for buys is we've got the 800 below the 200, the 200 below the 50, 50 below the 21, and then the 21 below the 8. And what we're looking for is all of them to be in order, the L50 to be in the buy zone, and that's just putting probabilities in our favour as much as possible through these two variables. Now we'll go through the rest of the variables on why I liked this idea first and foremost. And the way I determine this is when I do my markups before any trade that I enter, I have to go through a checklist that's printed off in front of me, and I've got it laminated and sellotaped to my desk and to my monitor. So before every trade that I take, I have to go through a specific checklist, and that's in the form of this box here, and I just write them all down and say what could be better, what is in my favour, just to help me grade this trade and allow me to size my position according to the grade of the trade. So the better the grade, the more risk I put on. The worse the grade, the less risk that I'm putting on. And if that grade is maybe a C or a D trade, so it's got maybe 2, 3 or 4 knocks, I'm not going to take the trade. So this is why I have this box here, just outlining the potential variables. I want to make sure I've got as many probabilities in my favour, and then when I'm confident that I have, I will then enter the trade. So that's what this box indicates, and it's just going through the variables, and I'll go through them individually on how I determine whether they're in my favour or they're not. So the next one after the perfect 50 and the EMAs is off the 21 EMA. So an A1, it needs to come off this 21 EMA. So you can see here that the open of this candle is on that 21 EMA as we push up through the 8. So I'm confident that that's off the 21 EMA. Then there's two things that we have on the RSI. So the first one is that it's in the correct position at the time of entry. And what that means and what we're looking for is this green line is through this yellow line and the red line at the time of entry. Now I know this doesn't quite look like it is, and the reason for that is because it's like an indicator. Once this bar closes bearish, as heavily as it does, this actually pulls this green line back under the trend line. But at the time of entry, this green line was definitely through this trend line, which is what we're looking for it to be on edge. If it doesn't, I won't even take the trade, even if the rest of the variables are absolutely perfect. This is one of the variables that is completely non-negotiable. This green line has to be through both of the other lines before we can even entertain taking this trade. The next one we're looking for is the Asian range to be broken. Now the Asian range is shown here in the form of this purple box, and what it's indicating is it's the range that the price action has traded in within the hours of 10 o'clock from the previous day to 6 a.m. in the morning. And what that's doing is it's just determining a specific range, and what we want it to do is we want to see price action break this box with a body of a candle either to the upside or the downside. Now in this instance, this candle here at the start of the London session breaks just above it with the body, price then continues up, and then we start to get a pullback back towards this high in the Asian session. You can see that we've got that pullback, we come back to the 21, we come back to this Asian range high, and then what we're looking for is a push back off and then to continue back up towards ADR or highs of day. The Asian range was definitely broken in this instance, and I'm happy to class that as putting probabilities in my favour. If that isn't broken, what it means is that price can just sometimes chop through that range. That's reducing our sort of risk reward, or again our probabilities. Then the next thing we're looking for is there any opposing divergence on the 15-minute time frame? Now divergence can signal change in price action, so it may mean that price could chop, it might reverse, but a lot of the time it signals that price action is going to change. And you'll see here the way we determine price action is from the RSI high to price action high. So the highest point of the RSI is exactly the same as price action high. If this was divergence, what we would see here is we would see this RSI point higher than this one, and then we would draw the divergence lines, and this one would be rising and then this one here would be falling if there was any opposing divergence. But you can see here that there's not, so that's another good sign that probabilities are in our favour. The next one that I'm looking for is, it's more to determine whether I've got enough risk reward to be taking this trade in the first place. What I'm looking for is a minimum of 2 to 1 on my risk to the high of ADR. And the ADR is the average daily range, and this is how far we can expect price action to move in a single day. So we've got to assume that today is an average day and price action will only ever go the average of the last set amount of days. Now that's determined by this green line here, and you'll see at this point that we've not got 2R to this trade that's above that green line. Now the reason for that is because we've got this downside move later in the day, which means that this has actually travelled more than the 68 pips of the average range. Now at the time of taking this trade, I've drawn on the average daily range, and you can see here at the time of entry this is where the ADR line was, and you'll see that we've got 4.75R at the time of entry, and I'll just show you how that was calculated for your benefits. So you can see here that we know that at the start of the day the average daily trading range is 68 pips, and we can measure that from the lowest point of the day here, so that's right at the start of this Asian session. If I get this measuring tool out on TradingView, you can see here that at the time, if we were to go from the low of the day to the top, it's 68 pips. So that's where that line would have been at the time of entry. And just to show you that the other way, if I now measure it from the high of day here, all the way to this bar here, you'll see there that it's 68 pips. So at the time of entry, we had 4.75R, signalling that we had great risk reward to take this trade to the upside. So then the next thing that we're looking for on the RSI is this not to be in an overbought position. and that's just potentially signaling exhaustion or a sign that price has moved significantly within the day. And again, it doesn't necessarily mean that price will reverse, it just means that there could potentially be changed and reducing the probabilities. So you'll see here that the highest that the RSI got within the day was 66, and we never breached this 70 value. So again, probabilities are in our favour, no knock, and I'm happy to take this trade based on that RSI. The final thing that I was looking at on my checklist is that the candle is not overextended. Now, the way that we determine that is that it's not the biggest body of the day. You'll see here that this candle at the start of the London session is the biggest candle of the day up until point of entry. And what this sometimes can signal is, with it being overextended, or the biggest bar, sometimes, not all of the time, as you'll see here, that price can sometimes pull back, but you'll see here that it doesn't, price continues up. So this isn't the biggest candle of the day, so therefore it's not overextended. And at the time of entry, I don't really see too many knocks. The only knock that I have really is it's not for a new high of day. If this was for a new high of day, we'd see candle close up here. They're fairly rare on the A1s breaking for new highs of days. So overall, I didn't really have too many knocks. I thought this was a high probability trade, and one that I'd be happy to take should it present again. So in regards to the trade management, based on the analysis that I'd done and my markup pre-entry, I was satisfied that this was a trade that I wanted to be in. I felt probabilities were in my favour, and I entered at the close of this candle as per my entry rules. I put my stop below the wick really at this time, just to probably increase it a little bit more. It has been tested at the body close, or the body open even. But I decided to just give it a little bit more room, put it below the wick, and then you'll see here the price did move in our favour initially during the start of this candle, but then it did quickly reverse and then took me out at my stop in the very next candle. So I didn't get a chance to reduce any of my risk, and the only way that I would reduce risk on an A1 is if the next bar is bearish. I would reduce my risk by sort of 50%, but unfortunately the next bar did finish bearish, but it went all the way through my stop in one move. So I ended up taking a full loss on this trade. And then from there, price continued to make lower highs throughout the rest of the day and just continued to drop, holding that 8 and 21 shift when we got it off this candle. So looking back at this trade, I feel like it was a good entry. I don't feel like I did anything wrong in taking the entry. I think probabilities were in my favour enough to take this trade. So I certainly don't think it was a trade that I'd taken off edge. And at the time, I don't think there was anything that I could have done from a trade management perspective to reduce my risk. This move happened very quickly against me. But in every losing trade, I want to make sure that I'm taking a lesson away from it. Every single losing trade, there needs to be a lesson to be taken from, and something that you could have done better, or something that you are going to do more of in the future. And when looking back at this trade, and it was pointed out by Austin when we were discussing this trade in the Black Shirt Club, is that this trade is very, very similar to the trade that we took on GBPUSD earlier in February. So back on the 9th of February, I think a lot of the ASFX members took a very similar trade on this pair. And what I'll do now is I'm just going to bring them up side by side so we can see the similarities between the two. And we also took a lesson away from that trade, and it presents itself again on this one, and it was something that I didn't take notice of, and now this has occurred twice. It's something that I need to be extremely diligent of moving forward, and it will be something that I'm going to put in my checklist before every A1 trade. So I'll bring up both the trades side by sides now, and we'll just have a look at the similarities between the two. So as you can see on screen, these are the two identical sort of trades that I've taken on GBPUSD using the same A1 signal. And this one here on the left is on the 9th of February, and this one here is this week's trade on the 23rd of February. Now, you'll see some similarities between the trades. So the first similarity is the consistency in the markups. This is because I've got a checklist printed off in front of me. So before every single trade, I go through that, I do my markup, and I determine the grade of the trade before I enter. So that's the first similarity, and you'll see that we've got the full trend in EMAs, we've got the market sentiment line in the buy zone, RSIs aren't oversold, we've got the Asian range broken, we've got 3 candle formations coming off the 21 EMA. So they are very similar looking trades. We've got breaking for new highs, pulling back to the 21 EMA, and then we've got a push up, looking for price to continue. In regards to the lesson I took from this trade on the 9th was this falling trend line. So you'll see here, notice the falling trend line on the markup. And the trend line is this red line here, and you can see that it's just falling against us as we take this trade to buy it. Again, on this trade that we've taken on the 23rd, you'll see that that red line is also falling. So this is something that I definitely need to be more aware of in the future on my trades, and like I say, I'm going to add it into my checklist that I've got in front of me. So now it's happened once, that's fine, I'll make a note of it, but now it's happened twice, it's something that I definitely need to be aware of, and this shouldn't really become as a surprise. There are people within the ASFX community, and especially one of the coaches, Lindsay, who always looks at this trend line and very rarely takes trades with the trend line going against her. So it's definitely something that we need to be aware of and learn lessons from the more experienced traders around us. You'll see here that we get some sort of A1 signals earlier within the day, and this is more of a shift candle both times really. And you'll see here that this trend line on both of these at the start of the London session, the trend line is just starting to actually hook up both times, and then price does continue up for the rest of the day. And then you'll see that price does continue up for a little while after these candles with the trend line following suit. So that's something that we definitely need to take away from this trade, is that falling trend line, and probably start to use that as a knock against us, and just to show that probabilities are reduced if that is falling or opposing the direction that we're trying to take the trade. During any trade review, what I like to do is I want to first of all find out what I did well so I can do more of that in the future, and then I also want to just review what I could do better and what I'm going to implement into my trading in the future, just to get better each time. As traders, nobody's got it figured out. We're always just trying to look for ways to improve, and that's all I'm trying to do in this trade. I find that my biggest growth opportunities come within my losers, so I pay special attention to my losers and I want to investigate them to see what I can do better, see how I can put probabilities in my favour moving forward. That continuous improvement is a mindset that we need to be in throughout our entire career as traders. None of us have it figured out. We're just normal people that are just trying to get better each and every single day, and it's no different on this trade. From a what did I do well perspective, I feel like my entry was okay. I feel like it was on edge. I went through my routine, I went through my process of doing the markup before entering it, determining my grade. Unfortunately, I didn't get an opportunity to manage risk in this instance, but leading up to the trade, I felt like I did everything by my rules, and as a trader, that's all I'm trying to do, is follow my rules. I've got no control over the single outcome of any single trade. All I can do is manage what I can control. I think I possibly lent into it a little bit much. I risked 1%, and with my commissions, I think I ended up at minus 1.09% loss on my accounts. So whilst a 1% loss on my capital is never going to ruin me, I probably feel like I shouldn't be risking this much on, well, really on any trade. So earlier in the week I did a video on expected drawdowns and losing streaks depending on the win rate of your strategy. So if you've not seen that, please go and check that out, as it's a really interesting video that will show you how many losers and winners you can expect to have in a row dependent on your win rate. So please go and check that video out, and if you do find value in that, please like and subscribe and give a comment below on that one. So I'm probably going to look to start reducing my risk now a little bit more on my A, B and C setups, and just to protect my capital a little bit in these current environments, and just to sort of limit my drawdowns overall really. So that's what I think first thing I could do a little bit better. The second thing that I can definitely do better is pay more attention to that falling trend line moving forward. Definitely going to add it into my checklist, as I've already said, and therefore it will be in my markups moving forward on A1s and even some of my D1s. Now, I had a lot of success in December and January, and I didn't take any A1s, and I think I'm going to cut A1s back out of my trading. And this is not in any way to say that the A1s don't work, because that's absolutely not true. There are plenty of coaches and funded traders that trade the A1 extremely well and extremely profitable, and we've got a whole host of data to back that up. But for me personally, that's just not where I have found success, and I need to go back to what led me to be successful and to get funded, and that was trading the D1s. And I'm going to probably take the A1s back out of my trading plan for a little while again, and just until I can build up that confidence, start to see the A1s a little bit better, and just stick to what my strengths are, which is the D1. That is definitely something that I could do better, and something that I'm going to work on moving forward. That's it for this trade. So this was the only trade that I've taken this week, so just the one, down just over 1%, so not too much damage done really. February's been a little bit difficult. I feel like I've traded my rules pretty well. I've stayed pretty patient throughout February. I've not taken too many trades, but every single strategy is going to have periods where we're not creating new highs on our profit and loss every single trade. It's just not possible. There are periods that are where we're going to have a few losing trades, and this is just one of them. So what we need to do as traders is become better risk managers, manage our risk, and just make sure we survive to the next trade, because we're now one trade closer to a winning streak, and that's what we need to remember throughout this. And that video that I've just posted this week will help understand that and put that into perspective. So please, like I say, just go and check that out. But if you have found value in this video, as I've already said, please subscribe, comment and like below, and I'll be doing more of these trade reviews in the future.